Wow, wasn't that exciting, guys? Wow, Virgin Hyperloop One. He was saying maybe you're going to feel more comfortable after my speech with Virgin Hyperloop One. Are there any more volunteers after this speech? Going in a pod, in a low pressure pipe at 1,000? Jose Luis? Not me. Jose Luis and I will stay here. We'll watch you go, and then once it works, we'll go after, shall we? The little chickens. Okay, let's change from smart mobility to scalability program, shall we? Yes, yes, we can wait. That's what you're here for, aren't you, Jose Luis? Scalability programs. For many startups, getting acquired is the ultimate goal, the desired exit, isn't it? However, many founders refuse to sell their venture, and ultimately, they go public with a company. So when it comes to an exit, which is better when considering an IPO versus acquisition? Is it an IPO is a restart, an acquisition is an ending? I wonder. Do you wonder? Wonder no more, because we have a panel that is going to answer these and many other questions. And they're going to have a fantastic conversation between the general partner at Target Global, an investment firm, and a top entrepreneur, the founder of Olapeak, the #1 visual commerce platform. To moderate it, we have a woman that knows a lot about this subject, because she is, and I take a breath, because bear with me, Senior Assess Manager and Private Equity Professional and Spain representative of Euronext, the leading pan-European exchange in the Eurozone. Let's please welcome them all. They are Shmuel Shafet, Luis Sanz, and Susana de Antonio. Welcome, guys. Here they are. Welcome. Take a look.
Well, thank you, Elena, and welcome everyone. I'm glad to be here to have this interesting discussion with these two guys. We have Shamul, I'm sorry about the pronunciation of your name, sorry. As Elena said, a partner at Target Global, an investment fund with over 700 million euros in management that invest all over the different stages of investment, from seed to growth, and they have both experience in trade sales as to divest their portfolio companies, but also some IPOs, including Delivery Hero. So I think he has a very good experience. And then we have Luis, founder of Olapeak. This is a startup founded by a Spanish team that, well, it was never based in Spain, but in New York, but it was acquired by Monotype, also a US company that is listed back in 2016. So he has the experience in all worlds. So I think we can have a very interesting discussion. First, starting with you, Samuel, as a VC investors, what are the criteria you follow to decide with a portfolio company whether the right exit route is an IPO or a trade sale or a secondary sale?
Whoever pays more, usually. No, I think that we try to always think about companies as in independent terms. So can this company be independent? Can it be a long-term player in its market? Can it become probably a publicly traded company leading the market for a long term? Obviously, that doesn't always happen, and some companies will never get there. So maybe the market's not as big as we thought, and maybe there aren't the fundamentals to build an independent business. And then they would be sold. In some companies, there's an offer that's just too good to refuse, and then they would also be sold. But I think as a sort of general rule today, there is a higher bar for a public company to make an IPO really an option. So I think we see that companies under sort of a 5 billion, give or take, threshold don't get enough liquidity, don't get enough attention to really stay independent long term. There are companies who've made the journey from sort of sub-billion to that mark in a public market. A good example, an Israeli company called Wix which went public for about 800 million. Market cap is now 5.5 billion. So that does happen, but I think it's harder. So when we think of an IPO, we do try to say if the company has the volume that it takes. And we know that it takes longer, and so that's a big consideration for us today.
Okay, well, I think maybe that size of companies is easy to find, maybe in the US, but in Europe, I guess, unfortunately, it's more difficult to find those companies. But we also have alternative markets that also work well for small and medium companies, and there are also experience of companies that have done IPO and have done well in sizes below that. I know you had some mixed experience with Blue Apron, which was relatively small than that. So I guess that's why you say that.
No, I think Blue Apron is a different, maybe a slightly different story. It's also an American IPO, but these last couple of years, we've seen Zalando and Delivery Hero and Adyen all go public, all in Europe, all do very well post-IPO, all have real liquidity and starting to become substantial businesses independently traded in Europe. And I think there is a very, very strong pipeline of these European companies who can still get there. Mm-hmm. So, and who can be independent. And interestingly enough, I think more and more they opt to be traded in Europe. And Zalando sort of opened that path, and you can see that there's room for 10 billion, 15 billion publicly traded company in Frankfurt, and it gets enough liquidity, and people can move the shares, and people have sold billion-dollar blocks of shares. So, and if you look, by the way, at Blue Apron, there's HelloFresh as a comparable. Blue Apron went out in the US and got, unfortunately, it didn't do that well, and HelloFresh did very, very well in Europe, so it's...
Okay. Luis, from your own experience as you have been the founder of a startup, then you were able to scale it up with some international investors, and then it was finally acquired by an industrial player that is listed in the US. So you have the experience in all worlds. What do you think are the advantages and disadvantages of each one?
Well, it's always a trade-off between, as a startup, you have very limited resources, and kind of when you're part of a bigger corporation, you suddenly have the backing to be able to do more things. So the trade-off is you have more autonomy if you are standalone, of course, but then on the other hand, like the amount of risk that you're taking as a company is higher in the sense of, if things don't go well, the margin like for error is not that high as it can be once you're part of a bigger company. So I would say that's the biggest thing. I mean, at least for us and pretty much for every startup, like he was saying, you try to make it as big as you can, and particularly once you take money from a VC, at the end of the day, you are agreeing to a path where you're going to try to grow this at a pace that is, very high pace, and kind of at some point, or even every time you get to a different stage of growth, you have to rethink what is the most interesting option for you. Kind of like the amount of risk that you're going to take the company to the next level changes every time you do that. Market dynamics keep changing. In our case, for example, we do marketing tech. There is this consolidation at the top. There are like a few players there that pretty much bought one of each technologies. So even if you try to make it alone, eventually some of those guys are gonna buy your next competitor, and even if you're the market leader, suddenly someone has a sales force with like hundreds of people selling your competitor, and makes life much harder. So kind of you have to consider all those things as you grow, and I don't think there is a right answer, but for every stage of every company, there is a situation that makes more sense, and that's what you need to reassess as you grow.
Okay, so when you were back in 2016, when you received this offer from Monotype, did you also consider maybe, okay, I will try to go to capital markets, do an IPO, have some more financing, and take the company to the next level?
Yeah, so not to the capital markets, because as he said, we were not big enough, and kind of, it's right now, I mean, if you think what was an IPO like maybe 20 years ago, we were at that level already, like kind of like a couple $100 million. but not necessarily, that's not an IPO today, kind of. If you don't get to the billions, kind of, at least in the US, you don't even think about it. And mostly because like private markets will provide you with all the capital needs that you may have to take it to that level. So till then, you just do it privately. So for us, the option was either we do another round of funding and try to grow this and take it to the next level, or kind of we got this acquisition offer, and as he said, was good for everyone involved and kind of too good to pass. So that's how we ended up there.
And what's your view regarding Europe versus the US? We have always this debate, and there is the question if there are really European companies that can go to the next level and really compete with US companies, because as we have been discussing, in the US it's very normal to find companies with multi-billion, whereas in Europe are really few that reach that valuation and that degree of development. What do you think is the reason for that? Samuel, I don't know, what's your view on that?
I mean, it's not a secret that Europe is much less dynamic economy than the US, right? I think if you look at the DAX 25, there's only one company founded after World War II. So it's SAP, and it's also, incidentally, the only European tech company to ever reach $100 billion. But then if you look at the 10 biggest companies in the US stock market, they're mostly today tech businesses. And obviously those businesses are very acquisitive, and they have tended to acquire a lot of just US businesses easier. And capital markets have always been very US-centric, right, for the tech world. And even you see European companies like Spotify have chosen often to be traded there, and a lot of Israeli companies are also traded in the US. I do think that, again, this last 2-3 years have been a significant shift in Europe. So there's more money coming in. You know, we live in very, very odd times where investors come and invest billions in private companies, and that's also helpful in building these bigger businesses. And I think we're slowly starting to see European companies of scale. And the more companies of scale there are, the more companies of scale there will become, because first of all, there's more money around the market to be reinvested. There's sort of this benchmark that people can aspire to. Capital markets start to get used to it. Investors start to get used to investing in these loss-making companies and giving them the right valuations. And also, those companies become acquisitive and help build sort of smaller startups around them. I think, for instance, Delivery Hero has probably spent $2-3 billion on M&A so far. First of all, as a private company, now as a public company, so they sort of fuel the market around them. So I do think we're starting to see a shift. It's not still, even comparable, remotely comparable. And I think the second thing is the traditional European companies are not very acquisitive, not in the tech world, and that also is slowly starting to change as they understand that they need to acquire rather than build themselves. But still, there's a huge gap between the US and Europe in that regard. And until that gap starts to shrink, the ecosystem here would not grow, really.
I don't know if you want to.
Yeah, no, I think that's totally on point. I think there is that virtuous cycle that, once you get good companies, eventually you have, like they generate return to investors. Eventually you have more money to be invested in the next generation. Then you have more, seasoned entrepreneurs that already had experience to scale to a point. You also have role models that, you can actually make it to a point that you never thought it was possible before. That also makes investors shift their risk profile a little bit, because suddenly you're thinking, I can actually make it to $1 billion exit in Europe, which is something that people weren't necessarily thinking a few years ago. And that creates that virtuous cycle that kind of like, successful companies bring more successful companies. And kind of if you think about that cycle, maybe in the US, they have been like 7 times around the block already, and here we're maybe, 1 or 1.5. But you can see how things are changing. You just need to look at the recent examples of kind of like companies growing here and kind of how investors are kind of like just investing more because they realize that there is potential to do that here. It's obviously not even close to what is there. There is also an advantage here that in many ways, I mean, kind of you go to the US, you have 10 times more access to investors or capital or you name it, but you also have 10 times more competition. So kind of, it's like, it's not that it's much easier. You just go there and just grab money from anywhere. So, it's a trade-off everywhere.
Yeah, in general, what all startups claims that having access to early stage financing is relatively easy, at least in Spain or Europe. But when you start growing and you start looking for 10, 20, 30 million, it becomes more difficult. And sometimes companies have to need to have 2, 3 VCs or even more, and they all have a seat in their board, and they will have an opinion. They have a different interest, which can be contradictory, and there could be a conflict of interest with the founders. Whereas, for example, comparing with an IPO and capital markets, those investors do not want to have an influence in the management, and really allows management teams and founders to be independent and follow the strategy they have in mind. I think that's really important for founders, and I think it's a key differential point. I don't know if you really see that as something valuable that you would have liked maybe to have in your experience.
I mean, it goes both ways. I mean, we're part of a publicly traded company now, and you also have plenty of responsibilities. You have to report to the street every quarter, which is something that you don't need to do as a private company. So, yeah, I mean, you may not have someone, you still have a board of directors, maybe not full of VCs, but you still have a board of directors that have fiduciary duties with everyone, and it's not that I would say it's not necessarily better, it's just different, and it is true, I will say that once you become a public company, probably the level of risk that you will take in many situations is probably lower than you will do as a private company, and I think that's one of the reasons why many of those big companies, think of Uber and Airbnb, decide to stay private for longer, because you have more room to experiment and continue making aggressive bets that if you were public, it would be much harder.
I mean, I also think that, it's true that Europe has less capital across the stack, but I think that growth capital is very international today. Today, it changes with the cycle. When this current cycle starts to sort of ebb, then a lot of the American funds will obviously sort of get back. You can already see some Chinese money getting pulled back, but still, in general, growth capital, real growth capital is global today. I think there's a serious early stage problem in Europe. A serious early stage problem with there too little money, too little smart money. That's a big European problem. Once companies cross a certain threshold and sort of get to be a player big enough for the big growth funds, then they usually get funded. And once they get funded, if they're European or American, they have the same set of considerations about whether they want to go public, whether they don't. So I think in Europe today, the problem is in the lower end and the mid end of the market.
Yeah.
And as you said, small IPOs just don't make sense anymore. And used to, in the 90s, companies used to go public for 200 million market cap, use it to benchmark, use it to get some financing, use it to get visibility, and then slowly grow in the public market. But that can't happen anymore. So. Yeah,
and there's also, now it's much cheaper to start a company. So there is a lot of...
But much more expensive to take it public.
Agreed, yeah.
And much more dangerous.
There is this thing that in the early stage is much cheaper, and there are enough seed investors pretty much everywhere, and then as you go through the funnel, at the Series A and things like that is where you have the crunch, at least here in Europe, yeah.
And if you go to the alternative markets, and there are quite a lot of them in Europe, that everyone has one or two success stories of companies who started small, grew, exploded, but if you look as a whole, they're graveyards for sometimes good companies that got crushed under the need to be public and publish, but didn't get enough exposure for serious institutional investors who could drive valuation. And if you sort of look at small cap, publicly traded European internet companies, they're all very, very depressed in pricing.
Well, Well, I don't fully agree with that because in Europe we have companies that are doing well. For example, we have takeaway.com, which is one of the competitors of Delivery Hero. So you have the experience, and when they did the IPO, I think they were below 1 billion, so they were relatively scale up, but it was not a multi-billion, and it's a company that has been doing very well since the IPO. So in Europe, we have a lot of examples of companies, mid-sized companies that are able to grow and to develop thanks to capital markets. For example, by the way, you mentioned that Delivery Hero invested like 2.2 billion, I guess, in acquisitions or something like that. I think maybe that could be difficult to do being a private company. You know, the thing is that capital markets give you access in a recurrent way, an easy way to new funding. So I think that can help companies grow and take the next step, and that could be difficult being private.
I think that was common thinking, right? And I think it used to be very true. But Delivery Hero spent most of that money as a private company. Mm-hmm. And because today, there is an amazing amount of money available for private companies, both on the equity side, but also on the debt side. I mean, we're seeing private, non-EBITDA positive companies getting funded at 300-400 basis points. I think that's almost unbelievable. Yeah. So the cost of capital for a private company and a public company is almost converged. And as long as that happens, and as long as there's an active secondary market, which the mega funds create, then, you know, as a founder, I would say, why do I need to be exposed to the public? Mm-hmm. Why do I need to be exposed to regulation? Why do I need the overhead? Why do I need to report quarterly? Why do I need to deal with the public versus a small board of stakeholders who I'm relatively aligned with? Mm-hmm. I can get some liquidity, I can keep growing my business. Do I really want to take it public? Maybe when it's a prize big enough not to be able to get it in a private market, like Spotify. But if I were a $1 billion valuation company, I think it would be a very, very difficult question, and we have these conversations all the time with companies, whether they would float, and I think most cases where they've been marginal, they've decided to keep in the private sort of route right now. It will change. Capital costs will go up. It will change, and that's our market.
Yeah, and there is another thing that could be a differential for the following the different strategies. It's the retention of talent. What do you think about the advantages and how attractive can be a private company versus a public company for attracting employees, key management, because you're able to offer more attractive incentive schemes, being a public company rather than private? I think, well, you both have the experience.
I think, again, it was something that historically was a big consideration, and today secondary markets have evolved in such a way that they have liquidity solutions, and they give employees liquidity solutions that are sort of not as good probably as public markets, but they're adequate, and that's always a part of the consideration, right? How do I let people make use of their options? When you get to year 4, year 5, year 6, everybody's key people are fully vested. But we see more and more companies saying, let's do small secondary with employees, let's build some facility to let them cash out and take the pressure off. Mm-hmm.
Yeah. I think a big difference, at least that I have seen, is kind of if you're part of a public company, pretty much if you are giving stock to employees, you are giving them cash. I mean, you know what's the price, and it can go up, it can go down, but pretty much you know how much you are getting. So versus when you're still a private company, you're growing. Pretty much in most cases, you can put a value to your options, but it's an option, and in many cases it can go like really big, and in many cases it can go to zero. So if you think about people, it's like you have a family, you have kids, you have a mortgage, maybe kind of the idea of something more stable is more attractive to you, and while if you are willing to take more risk for a bigger reward, potential reward, maybe you go for the other option for an early stage company. So I think in terms of the kind of people that you can attract, you can find really good people in both cases, but kind of like maybe they are at different stages of life or they have different motivations. So that's important when you're thinking about recruiting in general. Yeah.
It's also a market maturity question. I think in places like Spain, where there's been less liquidity events, there've been less scale-ups, it's just harder to convince people that their options are worth something. Yep. But in somewhere like Israel, where there's 5 or 6 billion, sometimes more, of liquidity a year, or even in Berlin, people are starting to look at options as money. They understand the value of options. Employees are very savvy. They understand a strike price. They understand their private market value. Mm-hmm. So it's also, I think, in the less as the ecosystem, the more it matures, oddly, the less attractive public companies are and more attractive private companies are.
Yeah.
Okay, and now a more general question as a VC investor: what are your the things that you normally have in mind, or the disadvantages of an IPO versus a trade sale? I guess that probably the potential liquidity issues and so on. So what are the things you have in mind when you are, thinking about the equity story and also the exit route for your investments? What are the things you have in mind for?
I mean, I guess I have the disadvantage of being a VC for a relatively long time now. So I've seen good IPOs and I've also seen very bad IPOs. I think that the attraction about sort of a trade sale is instant liquidity. So you fix it, you get paid, it's done. Mm-hmm. An IPO, obviously the public markets can go either way. You're keeping risk for longer. Sometimes that works out, sometimes it doesn't. I think we're a bit of an opinion that every day you keep a stock, a publicly traded stock, you're deciding to reinvest in it, and I'm not a public market investor. I'm not smart enough to understand the considerations, so every day we keep that stock, we're just incurring risk that we probably shouldn't incur. On the other hand, companies that go public, sometimes it's a great company, we do want to we wouldn't sell it had it been our choice, let's say. Maybe we think that there's still room to go. So it's a complicated situation to own publicly traded stock. Yeah. I think that's the big sort of advantage. You get a price, you get paid, it's done, and I think sometimes it builds great things. We've sold companies that, looking at them 3, 4, 5, 6 years later, have become, in their new homes, just gigantic businesses, employ thousands of people, do amazing things, and it's also a consideration.
Yeah, but also the IPO, in case you really believe in that company, and you really think that they have a brilliant future ahead, that gives you the opportunity to participate in the upside as well. So, but of course there is a risk associated with that. Yeah.
But then there's a question of whether we as venture capitalists get paid by our investors to hold stock that they can just buy. So whether it's not, I don't need to sell, distribute the money, and whoever feels there's still upside can do it on his own at a cheaper just cost to doing it. I think that's always a big consideration for us.
Sure. So, and Luis, now that you have you already had the experience to create and found your startup, you sold it, so you have a success story behind. You have your future, you have a comfortable situation now. In case, imagine that you create a new startup and you start from the beginning and you have the opportunity to really scale it up and take it to the next level. What route could you follow? Could you consider it maybe more going to the capital markets and really try to make it a global player, or would you follow the same strategy as you followed with Olapic?
Well, I don't know yet. There will be time for that. But I've seen other people getting acquired, and then kind of you get that chip on your shoulder that you didn't make it till the IPO, and then they go for the next one and go big. And I've seen the opposite too. That kind of like they did it, and it's like I don't want to know anything about this anymore, VCs included. So it goes both ways, and I guess that it depends on the person. Yeah.
I hope next time it will include Target Global.
Okay. Since business cards afterwards.
Okay, so well, thank you very much. Well, as a wrap-up, I would say that it depends on the size, on the company, and the management to decide what's the right strategy, and each one has advantages and disadvantages. So well, thank you, and good luck with your next investments.
Thank you.